Hello, very good morning to all and welcome to a brand new week ahead. I'm Kelvin Wong here again, the Senior Market Analyst of OANDA Asia Pacific. Welcome to today's Daily Dose of Market Insights. Today will be Monday, the 15th of April, 2024. So before we start our Daily Dose of Market Insights, let's take a look at, as usual, the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook for today on the broad-based cross asset classes, that means we're talking about the major stock indices, the major FX pairs, XAU/USD, that's gold, and as well West Texas crude oil. Let's have a recap what has taken shape over last Friday and most importantly over the weekend. So we know that last Friday there was a very risk-off sentiment. I would say why risk off, because the major US stock indices all ended in the red, dragged down by the three major US banks earnings guidance that is came in weaker than expected, which is Wells Fargo and JP Morgan, despite the fact that Citigroup managed to beat profit expectation. So let us start with the bank's earnings first. All right. So basically, if you look at the news flow, it's pretty negative on the banks. Okay, so what we could see over here is the initial expectation that was actually before the release of last Friday's earnings result of JP Morgan, Wells Fargo, as well as Citigroup. So the market is actually expecting a much more better earnings guidance, especially from the net interest margin. Okay, what is net interest margin? It's basically the interest these banks loan out to their customer and corporate minus off the cost of getting the fund. That means, think about it, the cost of getting the fund is getting from the wholesale market or getting from retail depositor. All right, so this is how corporate banks make money, not from the investment side of the story. So what we could see over here is that initially shareholder has expected slow Fed cuts to boost bank profit, but however, JP Morgan net interest income actually snapped streak of sequential gains. That means what we could see over here is that they actually, JP Morgan and Wells Fargo, both of them reported net interest income from lending miss analyst expectation as of Friday. All right. And also at JP Morgan, the net interest income slipped from the prior quarter for the first time in almost 3 years. And also, overall, they actually give also a lackluster guidance on net interest income being lackluster in the next coming quarter as well. So that's actually explained to us the financial sector underperformance on last Friday. So if you look at the heat map on last Friday on the S&P 500, okay, let me share with you very quickly. Okay, it's a bit slow right now, so hopefully. Okay, so while we are waiting for the heat map, right, to actually be shown on my screen, so let me share with you. Okay, it's shown really very good. Okay, let me share with you. Okay, so overall, right, almost close to 90% of the component stock inside the S&P 500 all ended in the red. So if you look at the financial banks, the sectors, the banks over here, okay, JP Morgan is the worst hit, down negative 6% or 6.5%. So that's actually the worst daily loss in almost 3.5 years for JP Morgan. So that actually also dragged down Bank of America, Citigroup as well, down negative 7%. So overall, among the 7 mega cap stocks, the one that is holding the fort is Apple, positive 0.86% due to the fact that markets actually having that optimism of that AI driven M4 chips that are going to be released in all MacBook pretty soon. Okay, but that's only optimism, despite the fact that the rest of the 7 mega cap stocks failed to actually have that positive feedback loop back into the market. Okay, so two things are actually happening right now. Number one, two major banks, I would say, JP Morgan Wells Fargo, weaker than expected net interest income drag down the entire financial sector, which has a negative spillover feedback loop into the market. And secondly, we have two macro factors that has also have an adverse impact on the market. First macro factor will be the higher cost of funding going forward that will potentially trim net profit margin on aggregate for growth stocks especially. So what is this higher cost of funding? Is actually related to the US Federal Reserve latest stance of keeping interest rate higher for a longer period of time based on elevated sticky inflation, and that is now being so-called solely priced into the market. And what we could see over here is that US 10-year Treasury yield. Okay, let me share the US 10-year Treasury yield on my screen. So the US 10-year Treasury yield managed to broke above a key medium-term resistance at 4.5%. Okay, notice over here, it broke above that 4.5%, and right now is attempting to actually inch back up again during the Asia session today. All right, so with the break of that 4.5%, and the RSI, yes, is overbought, but it's showing no sign of exhaustion because price action on the RSI going to show higher high as well, in line with the price action on the US 10-year Treasury yield raw price action. So there's no bearish divergence, indicating to us that momentum is still pretty much positive. Potentially, we could start to see another round of a multi-week rally, potentially on the US 10-year Treasury yield, holding above the 200-day moving average. All right, that is now acting as a support around 4.26% level. All right, so that's one of the adverse macro factor. Second adverse macro factor over here is rising geopolitical risk tension that is keeping oil prices pretty much firm. Why? Because it's related to the Middle East. As you know, that Middle East is one of the key players or key supply players in oil, and oil this time around might be used as a weapon to actually lobbying US to ask its close ally Israel to stop its aggressiveness towards Hamas. And Hamas ally in Middle East right now has started to ratchet up their tit for tat hostility towards Israel. So especially what we see over the weekend, Iran actually first time launched a not really a surprise attack, because this has been pretty much in the news headline already, but market is now awaiting for the response of Israel. All right, what are they going to do next? Will they further retaliate against Iran assets in the Middle East? So if that really does happen over here, that could actually increase geopolitical risk premium up by another notch, and that could actually see higher oil prices, which could potentially fit into higher inflationary expectation and eventually see higher cost of funding via the rise in the US 10-year Treasury yield. That means, i.e., supply side inflation getting sticky in US, the US Federal Reserve is being boxed in a box right now, unable to do anything. They can't actually, number one, cut rates because of higher inflation. They also can't do anything because the lagging US economic indicator that they monitor not will be number one will be the robust we call it job market that is still resilient, and perhaps the only can able to actually cut rates aggressively is the some system in some financial shock that occur in the US stock market. That means, i.e., potentially we could see a major financial player going kaput. Then thereafter we may start to see another steep fall in the US stock market within a very short pace of time, that could lead to what I call the shorter term funding market, like the 1 month we call it repo market start to spiking up, that could actually lead to what I call more justification for the Fed to step in to reduce interest rate to actually calm the nerves of this tighter financial condition that potentially could spill over into the greater real economy. But until that happens, at this moment in time, unfortunately, we don't see that scenario happening. Okay, so the unfortunate case right now over here is that in order for the Fed to cut rate, we need to see a adverse movement in the stock market first, which I just explained to you all earlier on, the mechanics of it. All right, so this is the intermarket linkage that happened last Friday, and for sure, who are the beneficiary? uh, Gold initially rallied higher to hit fresh all-time high at 2,420 per ounce. That is the spot XAU/USD. But what's interesting over here is that after hitting that 2,420, which is our resistance level as well, still recall we will have that short-term bullish bias on spot gold on last Friday. So after hitting that 2,420, gold actually plunges close to about 0.8% down. So that actually explained why to us that there's a bit of front running in speculative position taking ahead of this Israel-Iran hostility, which has already kind of been priced into the market. So later I'll touch on the spot gold price movement, why there was actually a pullback yesterday, because the technical factors on Friday middles in after hitting 2,420 actually explained to us gold is in a kind of an extreme over long position. Okay, so now the next thing I want to highlight over here is US dollar. So US dollar also being the beneficiary of this hostility. Traditionally, US dollar is being seen as a safe haven, at least in the shorter term perspective. What we could see over here is that the US dollar, where's the dollar? Yes. So the US dollar, okay, actually rose and very clearly it broke above the range resistance of 104.95 over here for two consecutive days. It broke above its dotted red line, and right now it's trading way above the 20, 50 and the 200-day moving average, and also the 20 and the 50-day moving average starts to inch much higher, indicating to us that right now DXY, the US dollar index on the aggregate, is showing signs of very a new potential medium-term uptrend phase that could potentially retest the major uh, uh, range resistance of 107 next. And with a stronger US dollar keeping back in check over here, there's actually a risk that key emerging currency will start to get weaker as well, especially the Chinese yuan over here. So the Chinese yen now is attempting to actually break above the 7.26, 7.3 key medium-term resistance level. So once this level break, potentially we may start to see another round of impulsive up move to actually potentially see a retest of that October high. So if this scenario starts to take shape, right, a break of that 7.3 medium-term resistance in the dollar Chinese yuan, that could also spark currency war. Why? Because other emerging economy, which is pretty much dependent on exports, such as we talk about India is one of them. We talk about South Korea. We talk about Taiwan, and also Singapore as well is being driven by we are a small little country which is driven by exports. So all these countries will be forced to actually indirectly devalue their currency against the dollar if this dollar momentum continues. So that also will lead to what I call higher imported inflation for this country, which also potentially could drag down economic growth. So that is actually an adverse macro factor, which eventually will spill into another bout of risk-off sentiment into the market. Okay, so that's the linkage we're having right now. Okay, one more important news factor on the highlight is just right at the start of today's Asia session, there's this research group called IDC. So IDC is a pretty much reputable powerhouse that track smartphone market, the major the industry-wide smartphone market, and based on their latest finding, they actually found that Apple, amongst the major competitor, total shipment actually plunged 10%, while Android rival actually rose. Okay, so what we could see over here is in this the Q1 numbers just not long ago, Apple only shipped lesser versus the rest of its competitors. So what you could see over here is that Apple actually is the worst performing among the major major smartphone players globally, based on the IDC Q1 report cut or reporting on the global smartphone market. So Apple shipment actually plunges year on year in the recently concluded Q1 of 2024, negative 10%, almost negative 10%, whereas the rest of other competitors like Xiaomi is up positive 34%. Then you have the rest. Oppo is a China one, down negative 8.5%, and Samsung almost unchanged. So what we could see over here is that Apple share is slowly getting lesser and lesser in terms of the total number of phones being sold as compared to its rivals. And one of the primary reasons over here is due to the ongoing geopolitical tension between China and US that saw Apple iPhone shipment getting lesser and lesser in China. So what we could see over here, due to the hostility between these two countries, China is actually waging this war, indirect commercial war with Apple, and we know that Apple itself is the largest. Okay, it's now the second biggest component stock in the Nasdaq 100 and the S&P 500. So if Apple shares continue to remain lackluster and they eventually starts to actually shape a steeper decline due to going forward a weaker guidance, and let's see how AI will actually benefit Apple going forward, given the fact that Apple is late into this AI team play. And that being said, being the second biggest component weightage stock in S&P 500 and the Nasdaq 100. So these are the two global major stock indices that could potentially have another round of adverse risk of impact on global equities as well. Okay, so these are the key linkages and news event that has taken shape on the Friday, over the weekend, and as well as today's Asia session. Okay, so with that, right, let us now go forward towards the short-term technical outlook that I share for you all for today. So let us start with the major stock indices first. All right, major stock index. Okay, so let us start with the, okay, one second, the Hong Kong 33. Okay, so on the Hong Kong 33, right, what you could see on the, let's take a look at the daily chart first. So sometimes things getting a bit messy on the hourly chart. It's good to have a step back and see what's going on in the bigger time frame. So you look at the bigger time frame. This is the Hong Kong 33, which is the Hang Seng Index. Okay, so before saying that, let me expand my screen so that you guys can see. Okay, good. So for the Hong Kong 33, what I could see over here is that every now and then there was a bearish reaction on last Friday by this shooting star candle, two shooting star candle on last Thursday and last Wednesday, right below the 17,000 key medium-term pivotal resistance, which is the long-term secular bearish trend channel upper limit since February 2021. And what you could see over here is that price action also failed to actually break above the pullback resistance of this this medium-term ascending channel that I drew from the low of 22nd of January as well. So indicating to us, right, whatever rebound that we see at the start of this year are just minor counter trend rebound within its major downtrend phase. And right now, potentially after last Friday bearish candle, it could potentially kickstart another round of impulsive down move within this major downtrending phase that potentially could unfold, with the first support level to watch will be at 16,135 for sure, that managed to cap previous bears in check since 5th of March 2024. Okay, so that is the higher time frame chart over here. So now on the shorter time frame, so that will actually the reason what I'm using is, I'm trying to share with you all, is using a daily chart give me a better picture where is the bigger trend that is going. And with this bigger trend picture, I'm now intending to actually formulate a shorter term technical outlook that goes with the higher time frame. All right, so now on the hourly chart, okay, I'm going to share with you on the hourly chart. what we could see over here is that the price action of the Hong Kong 33 index now managed to actually shape a bounce, okay, shape a bounce right at the 50-day MA, and also right at this medium minor swing low area of 22nd of February and 27th of March, acting as a near-term support at 16,335. So right now it's actually working out its extreme oversold position that being made on last Friday. So as well, we all know that price action, right, don't go down vertically down. There will be oscillation in between. So right now, right, we know that the major trend is down, and that could be the start of a major impulsive wave. So with that, I will flip to a bearish bias from today. So if you recall, on last Friday, we have a neutrality stance on last Friday due to mixed element. But right now, elements are getting more clear and it's more skewed towards the bearish side rather than the bullish side. So I will actually use the 20-day moving average acting as a key short-term pivotal resistance over here, which is at 17,760 level. So if you to do the Fibo retracement, all right, of last Friday push down, that actually correspond to the 50% Fibo retracement, all right, as well. Okay, so any potential bounce that didn't surpass 16,760, we will have that short-term bearish bias on the Hong Kong 33 for today. First support level to watch for sure will be 16,335. Then a break below 16,335 will expose 16. Okay, so it will be a range, 16,135. Okay, which is here 16,135. So it's 135 slash 070. Okay, 16,135 slash 070, which is the exact minor swing low of 5th of March. Only an hourly close back above 16,760 will negate this short-term bearish bias to see an amount of choppy movement to retest 17,230 again. Okay, so that's for the Hong Kong 33, flipping to a short-term bearish bias for today. Japan 225. So Japan 225, last Friday, we will maintain our short-term bearish bias, holding below the 20-day moving average. So price action indeed plunges down and hit right exactly at the support level at 38,770 before bouncing off during the US session. And right now, during the Asia session, it started to actually hit higher as well. Okay, so it's up around 0.6%. So for sure, right now it's actually also following the Hang Seng Index, working off its oversold condition, short-term oversold condition that was seen on last Friday. So with that, right, that could be a sign of a potential minor bounce. First resistance to watch out for the minor bounce will be this area here at 39,500 level. So what's 39,500 level? Minor congestion area that you could see on my screen pretty clearly over here. And as well as if I do the Fibo retracement of last Friday entire sell-off, that actually correspond close to the the golden ratio of 61.8% Fibo retracement as well. But I don't want to use 39,500 as a key short-term pivotal resistance level because it's too tight, and given that it hasn't broken below this minor swing low area of 5th of April. So potentially it could be still inside this kind of rangy configuration again, now attempting to actually stage a minor bounce towards the top of the upper limit of this range. So I will use the upper limit key resistance of this range level for sure again at 39,810 will remains as the short-term pivotal resistance level at its confluence, also the upper limit of this minor descending channel that I drew from 22nd of March, and as well as the 20-day moving average also acting very closely to this level as well, having more key elements pointing to the similar levels at 39,810. So using 39,810 remains as a key short-term pivotal resistance for any potential bounce that could take shape right now. Still maintain that short-term bearish bias. First support level to watch 38,770. A break below 38,770 exposes the next near-term support level at 38,340, which confluence with the minor swing low of 12th of March and 15th of March. Only an hourly close above 39,810 will invalidate this bearish bias to kickstart a minor counter trend rebound scenario to expose the next resistance level at 40,260, followed by 40,760 level. All right, so that level, if we do the Fibo retracement of this entire current minor corrective decline, okay, from last Friday, that actually correspond to the 61.8% Fibo retracement at 40,260. All right, now next up will be the European index, which is the German 30 or the DAX we call it. So the DAX last Friday we attempt to that counter trend rebound at 17,900. First resistance 18,210 followed by 18,310. So first resistance has been met at 18,210 at the start of the European session. Then thereafter it traded sideways before plunging down in line with the weakness seen on the US stock market. And with that, right, given this level of 18,210 has already been met, so more or less the counter trend rebound has already been met already. So right now we will start to see another round of impulsive down move within this short-term downtrend phase that is still involving in the German 30 index. All right. So with that, using 18,210 as my short-term pivotal resistance level for sure, also close to the 20-day moving average. So right now, potentially there could be a bit of minor bounce coming back into the upper limit of this descending channel, very close to the upper limit of descent channel. First resistance to watch will be at 18,075, but I don't use 18,075 as my key short-term pivotal resistance level for today. It's a bit tight, so using 18,210. So as long as any potential minor bounce didn't surpass 18,210 level, flip to a short-term bearish bias on the German 30. First support level to watch for sure will be 17,900. A break below 17,900 exposes the next support level at 17,680, which will correspond to the rising 50-day moving average as well. Okay, so this is the minor swing low area of 6th of March and 11th of March. Only an hourly close above 18,210 level will invalidate this short-term bearish bias to revive the minor counter trend rebound scenario again, with the next resistance coming in at 18,310 followed by 18,395. So what's 18,310, 18,395? If we do the Fibo retracement of this ongoing entire minor corrective decline phase, is close to the 50% and the 61.8% Fibo retracement. All right. Now, the US indices on the US Wall Street 30. So US Wall Street 30 on last Friday, right, we are having that 38,080 level as my short-term pivotal support, looking for a potential counter-trend rebound scenario to take shape. But we do have a kind of trigger level, which at 38,600. 60, but that 38,660 didn't taken out on the upside. Then thereafter price action start to get lethargic and see that plunge coming forward, going into the US session last Friday, reinforced by that lackluster earnings guidance from JP Morgan and Wells Fargo. So with that, right, given the fact that failure to break above 38,660, indicating to us that whatever counter trend rebound scenario that we have on Friday has already been diminished in terms of probability. And right now, we are in the state of another round of impulsive down move. We in is a short and medium term corrective decline phase. Why? Because US Wall Street 30 is one of the weakest major benchmark stock indices, and it broke below the 50-day moving average, whilst the SPX and Nasdaq 100 are still holding above the 50-day moving average. All right. So with that, right, the RSI, yes, it hit the oversold level and it managed to react positively from the oversold level, indicating to this slight minor bounce that's seen in the Asia session right now over here. So with this scenario, there could be a potential minor bounce going forward as it work off the oversold condition on the shorter term basis. First resistance to watch will be at 38,260, but I don't want to use this level as a short term pivotal resistance, a bit tight. Use 38,660, which will correspond to the upper limit of this minor descending channel. As long as any potential minor bounce didn't surpass 38,660, flip to a short-term bearish bias again on the US Wall Street 30. First support level to watch will be the lower limit of the descending channel at 37,770. A break below 37,770 exposes 37,390 next. So 37,390 is in fact the minor congestion area of 16th of Jan and 17th of Jan. Only an hourly close back above 38,660 will revive that minor counter trend rebound scenario again, to see a retest or to expose the next resistance level at 38,930, followed by 39,100, which also correspond to the 50-day and the 20-day moving average, acting as a resistance zone. Okay. Now, last Friday we turned neutral on the Nasdaq 100. So the Nasdaq 100 right now seems to be us that is shaping lower high ever since the current all-time high is being printed on 21st of March. Okay, that's the current all-time high. Ever since then, it's been rejected by this minor descending trend line and starts to print lower high, and it also reintegrate back below the former bearish ascending wedge support level, now turns into a pullback resistance as well. But it seems to us that it's still trading in this very messy, choppy sideways range configuration. So I don't want to use any in between of this sideways range as a pivotal resistance level. So I will use the upper limit, which is at 18,380 now. So any potential bounce on the Nasdaq 100, as long as it didn't surpass the upper limit of this choppy range configuration that is playing out right now, 18,380 short-term pivotal resistance, flip to a short-term bearish bias. First support level to watch will be at 17,940. A break above 17,940 exposes 17,840 next, which is the range support that is in place since 29th of February. Only an hourly close back above 18,380 will start to see a potential squeeze up to retest the current all-time high area at 18,470. Above it exposes 18,620 level. Okay, so net overall, what we could see over here is that we start to see short-term technical weakness coming back into the major stock indices, despite the fact that yes, we may see a bit of minor bounce on the intraday basis, but it seems to us that the impulsive bearish impulsive sequence has started to resume for the major stock indices that I share with you all. Okay, so now dollar. So let us start with the European currency first. Okay, so given the fact that I just flashed you all that bullish movement on the dollar index, so for sure we got to have a bearish bias back into the euro dollar. So still recall that euro dollar previously we have that neutrality stance on last Friday. So what we could see right now, again, the RSI has really hit down to the oversold region, and right now is attending to actually work its way up from the oversold region that was seen on last Friday. So on the intraday basis, potentially there could be minor bounce coming into the play. So so what we could see over here is that I want to trade with the bearish impulsive sequence trend, which is pointing down rather than up. Any potential rebound over here, I will actually fade it. So potentially, right, what we could see over here is a potential minor bounce, but as long as this potential minor bounce didn't surpass today's short-term pivotal resistance at 1.070, we will flip to a bearish bias for the next support to come in at 1.06, followed by 1.0525. Okay, so what's 1.0525 is in fact this minor swing low of 19th of October, 27th October, and 2nd of November last year. All right, and close to the one-time Fibo extension level as well. Then only an hourly close above 1.070 will invalidate this bearish bias for today to see a much more substantial corrective bounce to expose the next resistance level at 1.0760, followed by 1.08, which confluence with the 3 moving average that is I think close to this resistance level pretty closely. The 20, the 50, and the 200-day moving average are all pointing down as well. Now, the sterling dollar as well. So sterling dollar also failed to actually see any meaningful bounces. What we could see is that yes, it plunges below the 1.2520 level. So what's 1.2520? So 1.2520 was initially the range support level that was held since 12th of December last year. Rebounded, and very close to here, it rebounded, and last Friday it just broke through. So indicating to us that whatever bounces within a range configuration has been invalidated, and right now this potentially kickstart another round of impulsive down move for the sterling dollar. Yes, RSI starting to exit from the oversold region, or has really exited from the oversold region, indicate to us there could be intraday minor bounces as well. So as long as these minor bounces shouldn't surpass this former significant short-term range support, now turns into a pullback resistance at 1.2520. So as long as 1.2520 holds in any potential minor bounces, we will flip to a bearish bias on the sterling dollar. First support level to watch will be at 124440. A break below 12440 exposes 12380. So 12380 is in fact the minor swing low area of 16th of November and 17th of November last year. only an hourly close back above 125.20 will see a much more pronounced counter trend rebound scenario coming back into the sterling dollar to expose the next resistance at 1.2580, which corresponds to the 20-day, 200-day moving average. Above it sees the next resistance at 12650, which confluence closely with the 50-day and closely to the 20-day moving average as well. But net overall, if you look at the trend of the 20, 50, and the 200-day moving average, especially the 20-day moving average that is sloping steeply downwards, indicating to us potentially the sterling dollar now is in the midst of shaping the start of another impulsive down move, at least in the shorter term. Basis is only right now potentially there could be minor bounces given the exit from its oversold level as been seen on the hourly RSI. So other currency will be the dollar yen. So dollar yen, we have flipped back to a bullish bias since last week, given the break of that 151.95 level. So for sure, first resistance level has really been made at 153.60 on the dollar yen. So the next resistance to watch will be at 145.25/60, followed by 155 psychological level. Okay, this level here, 155, and also the Fibo extension of 1.15507. So give or take, I will actually round up to 155.10, right? That's the next resistance level to watch. Okay, so with that, this 1.52040, that is the support level that we have on last Friday. So given the breakout of 15360, we will tighten the key short-term pivotal support level. For sure will be this level here. That means last Friday minus swing low at 15280. Okay, so 15280 will be my short-term pivotal support in any potential minor pullback. So as long as the minor pullback didn't surpass 15280, we will still maintain that short-term bullish bias on the dollar yen. So however, if we start to see an hourly close back below 15280, then potentially this bullish bias will be negated to see the starts of much more substantial minor corrective pullback to retest the 151.95 level, which also correspond to the 20-day moving average. Okay, then Aussie dollar. So Aussie dollar, for sure, it really broke down below that symmetrical triangle range configuration lower boundary that is in place since 14th of February. So right now we will flip to a bearish bias, respect the price action. So using 65 figure level, which is the pullback resistance of that former symmetrical triangle range support, now turns into pullback resistance. As long as 65 figure level short-term pivotal resistance holds, we will flip to a short-term bearish bias on the Aussie dollar. First support level to watch will be 64.40, which is the swing low area of 14th of February. A break below it exposes 63.90, which is the minor congestion area over here. It's 25th of October and 14th of November. Only an hourly close back above 65 figure level will see another round of choppy bounce back into the picture to retest the bunch of moving average acting as a resistance level at 65.55. All right, 65.55, which is the 20, 50, and the 200-day moving average, all confluencing at the same level as 65.55. All right, a break above 65.55 exposes 65.90 next. So net overall, we will have that short-term bullish bias scenario playing out for the major FX pairs. Okay, on the dollar. Okay, short-term bullish bias scenario on dollar strength playing out in the major FX pairs. Okay, then now spot gold. Lastly, so not lastly, second last. Okay, spot gold over here. So let us start spot gold with the daily chart first. Okay, so as you know that this daily chart here, price action pierce up, hit the 2420 level, resistance level. So that's the first resistance that we highlighted on last Friday, that which is indirectly our bullish bias level. Then thereafter, you see a sell-off during last Friday session. So this sell-off, right, actually took place what we call a overextended rally. So what do you mean by overextended rally? By looking at the Bollinger Bandwidth. Okay, so this is the Bollinger Bandwidth. So you look at the Bollinger Bandwidth on last Friday, it went to a level of 0.14. So this 0.14 level is the highest level seen so far in almost 3.5 years. So the previous 14 level was seen in 17 over here, somewhere around in 12 August 2020. All right. So given it's more than 2.5 years of high Bollinger Bandwidth level, that actually explain a overextended rally, and this overextended rally is having a higher risk of a potential pullback that being set into place. So that intraday pullback take shape, and what we could see right now is that the RSI has started to shape that bearish divergence. Okay, very clearly a lower high, whilst price shape higher high. So lower high, extreme level of Bollinger Bandwidth not seen in the last, the most extreme level of Bollinger Bandwidth seen in the last 3.5 years or so. That increases the risk of a pullback scenario coming into play, corrective pullback scenario that could last for maybe days, given that it's a daily chart, to actually retrace close to back towards the support level at 2010, 2260, 2010 level. All right, which is so this bunch of upper uh, major upper descending channel resistance now turns into a pullback support level. All right. Okay, so now so with that, in the shorter term, we will now flip to a short-term bearish bias, given the short-term technical element on the daily chart has started to turn negative. All right, in terms of kind of a trend overstretch momentum on the upside. So with that, I'll be using any potential bounce that we see so far right now, as long as this bounce didn't surpass 23,000 level. So what's 2390 level is, if I do the Fibo retracement, okay, it's close to the 61.8 golden ratio, okay, of the last Friday sell decline, not sell of intraday decline. So as long as any potential bounce didn't surpass 2390, we will flip to a short-term bearish bias for that corrective pullback scenario to take shape. We in it short-term uptrend. Why the short-term uptrend phase is still intact? Because price action is still trading above the 20-day moving average. So now it's more like a retracement scenario, a bearish counter trend retracement scenario. So with that, first support level to watch will be at 2,327, followed by 2,300. Only an hourly close back above 2,390 will invalidate this short-term bearish counter trend retracement scenario to continue the bullish impulsive up move. For spot gold to retest 2420, above it sees the next resistance coming in at 2450 level. Now, WTI crude oil. So WTI crude oil on last Friday managed to hit the first resistance that we highlighted before pulling back. So it seems to us that it's now trading in a sideways range as well. Now back to the bottom of this range at 84.90 in the short term, but it's still trading within the upper half of this minor ascending channel that I drew from the low of 5th of February. All right, so with that, still no change, still maintain that short-term bullish bias on West Texas oil, but I will still use the 8320 level as my short-term pivotal support. As long as 8320 level holds, still maintain that short-term bullish bias, pardon me, on West Texas oil. First resistance for sure will be at 87.70. Above it exposes 89 figure level. Only an hourly close below 8320 will negate the short-term bullish bias to kickstart another round of corrective decline scenario towards 8080, followed by 7925. This is the next support that may be exposed next. If 8320 gives way, we also correspond to the rising 50-day and the 200-day moving average, also acting as a support in this support zone of next support zone of 8080 and 7925. All right, so with that, that sum up the short-term technical outlook highlight for today. So what are the key data to look out for today session? So today will be Monday. So on Monday today, okay, give me a minute. 15. Okay, yes. So today, Asia session will be pretty quiet. We don't have any more data as before the European market opens. So one of the key European data to look out for will be Eurozone industrial production, which is still relatively weak. Markets suggest a weak trend, of negative 6.7% year-on-year. That's for the month of January. So this data is pretty much lagging. So they are still reporting February figure instead of March. So it's like a 2 months lag due to the kind of data correction. So they'll be out data collection. So they'll be out at 5 p.m. Singapore time, then followed by there's actually a ECB official speaking at 6 p.m. Singapore time, then BOE Bank of England official speaking at 7:15 p.m. Singapore time. Then thereafter, the US session, one important data to look out for sure will be the retail sales number that is out at 8:30 p.m. Singapore time, where market expecting a slight dip month-on-month to 0.3% from 0.6% in February. Then thereafter will be pretty much quiet. And at the start of tomorrow Asia session, before our daily dose, we see a bunch of key economic data out from China. Q1 GDP growth out at 10 a.m. Singapore time, industrial production, followed by retail sales. So especially for industrial production and retail sales, market is still expecting a weaker number at 5.4% and 4.5%, below 7% on last month and 5.5% for retail sales last month. So overall, we still see that deflationary risk spiral scenario playing out in China, given the fact that the China top policymakers is not in a rush of enacting massive stimulus measures, both on the fiscal side and the monetary policy side of the story. Okay, so with that, that actually sum up for today's daily dose of market insights. Slightly longer, why? Because of important things that has already has taken shape so far in the global markets, which I actually explained to you at the start of it. So with that, have a great day ahead, and we shall speak again tomorrow.